What will these elections mean for the future of America's recovery? Well, to tell us a little bit more about that, I'm joined by Stephen Bell. He's chief economist for GLC. Stephen, thank you so much for coming in the studio. Now, it does seem like this is a turning point, possibly, for who the next president in the United States will be. Does this change your view on economic policies in the U.S.? I mean, how much should investors read into this?
I think there are only two issues that matter, in my opinion. One is, will they extend the tax cuts? And that may even happen before the new Congress forms. And the answer, hopefully, is yes, because there's no benefit in terms of lower bond yields from cutting the deficit in the United States, unlike this country. And people need the money to spend. So let's hope they do that. The second thing is, will they fight a trade war? Tensions have been rising, and I think they're going to try and avoid that as well. So that the main thing is that they avoid messing up. That's the thing, I think, globally. The real action...
Does messing up mean actually losing control of the two houses?
Well, some people think gridlock's good. They think government's bad, therefore they can't... I don't actually agree with that because of the need to actually do something to stop the tax cuts expiring. But the real action isn't in Capitol Hill, it's down the road at the Federal Reserve. That's where we're looking for... That's where everybody is talking about. And yes, it's going to be a real blow to Obama. Everyone expects that. And he's a wounded president. But to the world economy, there's not much for him to do beyond the two things I've mentioned, or not do in the case of one of them.
And the Fed, big week for the Fed as well.
Yes.
On a Bloomberg survey, a lot of our economists expect them to start actually with a $500 million program. Is that the kind of figure you're looking at, or will they be more aggressive?
Well, I think they should do a little bit more, and in particular, I think they should start off at a faster pace. The consensus is slightly shy of $100 billion a month, with a total of 500 over 6 months. Actually, most traders that I've spoken to are looking for a bit more. It's one of those strange things where people expect to be a bit more. And I think the Fed want to have a reasonably positive reaction. But the main thing is they've got a new weapon of easing. Just talking about it's had a dramatic effect. The stock market's at 15%, the dollar's down, bond yields are down, tips yields are negative. They've already had a big stimulative impact. They just need to follow through. So the detail, in a sense, has been done in all these public speeches.
So, Stephen, I wonder whether how much of this is actually priced in, and therefore, if they don't go slightly above, markets will be disappointed.
Yes, I promised myself when all this started that I would go into the FOMC with a short position, expecting bond yields to rise. But actually, I'm not. I'm not even going to have anything in the bond market because it's too tough to call. What I do think, though, is this is a positive environment for risk-taking. In the developed world, we have spare capacity. We've had a soft patch. I was surprised by it, but I think we're beginning to emerge from it. And to be honest, the most important statistic for me this week is not what the Fed does, which I think we know pretty well, or even all these central bank outcomes, although the Reserve Bank of Australia was interesting last night. It's whether the labour market data continues to improve. If that happens, the US is on a clear road to recovery, and the Fed will merely be helping it along the way.
Stephen, thank you so much. And of course, that US jobs data coming out on Friday.